All right, this has been the weekly market wrap up, the last one for 2022, guys. We talked about platinum and palladium shortage, and we also talked about the oncoming recession. Everybody, this is Rob Keens with goldsilverpost.com bringing you this week's weekly market wrap up. This is for December 30th, 2022. This will be the last weekly markup for the year. The next one we'll have will, of course, be in January, and we'll start looking at our preview for 2023 and what we think the year could bring. This time, we're going to kind of do a review of the economic data this week. We're going to do our normal look at gold and silver, talk about an interesting development in farming, which is actually very positive, and then end up with a little special segment talking about platinum and palladium. Platinum and palladium inventories are getting a little thin, and we're going to bring you the details on that. As of the time of this recording, gold is trading at $1,814.76. US down 37 cents. Silver trading at 23.67, down 21 cents. Overall for the week, not too bad. Silver and gold both end up higher where they started the week. Although 2 days ago, I'm sorry, on the 27th, actually, there was quite a bit of a fall in the silver market, a little bit of a fall in the gold, but they have been recovering since then. So overall, they should end up on the week and close the day solid. Looking at the economic data for this past week, not a lot because it's Christmas week, and I mentioned that would be the case. Although there are a couple of things which are really important. The trade and goods advance report is down 83.3 billion. And what does that mean? Well, according to the headline from MarketWatch, U.S. trade deficit in goods narrows to lowest level in almost 2 years in November. Trade gap narrows 15.6% to 83.3 billion, smallest since December 2020. The U.S. international trade deficit goods narrowed to 83.3 billion in November, according to the Commerce Department's advanced estimate released today. It is the smallest deficit since December 2020. In October, the deficit had widened to 98.8 billion from 92.6 billion the prior month. Economists polled by Econoday were looking for the deficit to narrow only to 97 billion deficit. So I want to make a comment on that. What we're seeing is inventory glut, and we're going to see a deflation in the economy because we overcorrected from the pandemic. There was pent-up demand from the pandemic. The economy got rolling. We produced too many goods, and now we've had a lot of channel stuffing and inventory buildup, which I have shown on our channel several times in the last couple of weeks. And that's going to lead some deflationary pressures, I believe, in consumer prices. And I believe we're in a little bit of a deflationary cycle before we head to the next big bump in inflation. Other big news, the S&P Case-Shiller U.S. Home Price Index came out. It was down 3.1%. Last month, it was down 9.8%, so not quite as bad. It seems like there's a little bit of a slow and deceleration in housing prices, but the housing market is still in decline. It has been for several months. We'll continue to track that in 2023. I do believe we're going to have a strong real estate correction. Whether that fully takes place in 2023 or it takes a little bit of time to manifest, we'll see. A lot of that has to do with the health of the consumer. And I'm looking really hard for that data to come out on how the fourth quarter was in terms of consumer sales. The early data that we had last week was consumer sales are pretty robust. Since they're 72% of the economy, that if it's really robust, that sales data that comes out, we'll get in early January. That could mean that we're in for a little bit of a recovery in the economy. We'll have to see. The more home sales data, the pending home sales index was down 4%. That's about double worse than what economists thought it would be this month at negative 1.8. Initial jobless claims are higher. It's a little bit of a negative rebound from last month. Economists were expecting 223,000 initial jobless claims. They got 225, and last month was only 216. So some continual job loss there. And continuing jobless claims, people that are continuing not to find work, hovering above analyst estimates and above previous months. Last month was 1.67 million, and we're sitting right now at 1.71. So again, more joblessness coming. Unemployment not finishing up the year particularly strong. We'll see what happens as we roll over into 2023 with the labor market. Chicago PMI, that's a purchasing manager index, came in at 44.9. That was substantially higher than expected at 40.5 and very much higher than last month at 37.2. That means that purchasing managers are seeing a little bit during the holiday season of better results. And that makes sense. Like I said, purchasing managers should be positive during the fourth quarter because that's when a lot of sales come through retail and they're going to see a lot of movement and a lot of demand. We'll see, however, if that folds over into the first quarter of 2023. Next week, we have really big week. Remember, it's the first week of the month. We always get both the ADP and the non-farm payroll numbers. Those are by far the most important. But we also get some key economic statistics on U.S. manufacturing PMI, construction spending, jobs. We'll get some FOMC minutes and see what the central bank is thinking. Jobless claims data will be out, factory orders. So we'll get some boots on the ground type of information about what's going on with regards to manufacturing. I wanted to break out the Chicago PMI report because it rose so much higher than people thought, 7.7 points to 44.9. Now, the Chicago PMI report is just a segment of the country. It does not necessarily reflect the Purchasing Manager Index for the rest of the country, but it's a good one to kind of follow. It's one of the major ones. The Chicago Business Barometer, also known as the PMI, rebounded to 44.9 in December. I'm reading from MarketWatch, from 37.2 in the prior month, which was the lowest rating since the 2007-2008 financial crisis. Economists polled by the Wall Street Journal forecast of 40.5, so not too bad. As we turn to the markets at the time of this recording, again, about 11 a.m. Central Time on Friday, December 30th, 2022, the Dow Jones is trading down 244 points to 976.39, down 0.74%. The S&P 500 is down about 30.88 points to 3818, and the NASDAQ is down 93 points to 10,384. All the markets look to be selling off about 0.75%. The Russell 2K is down $10.64, down only 0.6%. All the markets are down. And the live headline I'm seeing from CNBC about this is they're looking back at 2022, and it says stocks fall in 2022's final trading session as Wall Street wraps up the worst year since 2008. That's right. This has been the worst year for Wall Street since 2008. Looking at the currency, major currency pairs, euro is trading up over the dollar. USD is trading down to the yen, a little bit of dollar weakness. The pound is trading up to the dollar just a tad, and the US dollar is trading down to the Canadian. So a little bit of weakness in the US dollar, but overall still holding strong. As we look at the cryptocurrencies, in early trading on Friday, Bitcoin is down 55.49 points to 16,533.32. Ethereum is down 0.81 points, just slightly, almost even so far in the day at 1194.38. Litecoin up a 0.64 to 67.86. XRP unchanged at 34 cents. Overall, on the bond side of the market, still having persistently higher interest rates on shorter term debt, which means we're still in a yield curve inversion in the bond market, which has always been an accurate indicator of an oncoming recession. And the further and the longer that yield curve is inverted, the worse the recession, or at least to be some indication of that based on prior events. The 1 year is trading at 4.738%, the 2 year at 4.43, the 3 year at 4.233, the 5 year at just over 4 at 4.016. We see a reduction below 4% on the 7 year. It's down to 3.976, although it's up for the day 0.06% to 3.976, starting the day at 3.97. And the 10 year is below all of those at 3.879. Hence, the yield curve inversion. For those not familiar, yield curve means when you demand a higher interest rate for debt issuance in the short term than the long term. That's reverse of ordinary, because typically in the short term, you should have a higher grasp on risk and therefore require less return on your money, therefore lower interest rates. When those invert and all the rest of the bond complex is charging more for shorter term return on money on debt, for you loaning the money to buy that bond, that means that they're expecting a recession. So that explained. One little positive news I see as we end the year has to do with farmers. So congratulations to farmers. If you're in tech and you're a programmer, you may not be feeling quite as good as people in agriculture. And here, an article from Zero Hedge, believe it or not, now is a great time to be a farmer. Agricultural commodities are set to lock in another year of annual gains, the longest stretch in decades, prompting higher farm incomes. The Bloomberg Agricultural Spot Subindex, which tracks everything from corn, soybeans, and wheat to sugar and coffee, will lock in the fourth year of annual gains today. Bloomberg said that this would, in fact, be the longest stretch of annual gains since at least the early 1990s, as drought and war cut production and erode inventories, keeping global food inflation simmering. We're going to move on to the report on gold and silver, which is why you guys like to come. What do we got going on in the world of gold and silver? We're going to turn to the CME and look at gold. This is the gold futures volume and OI for the week. Of course, we're looking at Thursday's data. Friday's data will be out later today. We're looking down in the data, and it looks like we've had just modest trading volume to end of the year. That makes sense because we're pretty much done with the December contract. We'll show you that. And we're moving into the next big trading contract month for February 2023. That move has been occurring since the beginning of this month, and it looks like we only have we have on the last day of December no open contract. So 0 open interest for the December contract. That's officially been closed. The last 70 did deliver as of yesterday's data. As of Thursday, the last 70 contracts of silver stood for delivery. Delivered. The rest that couldn't be delivered came over here to EFP. That would be 1,392. What is exchange for physical, you ask, or EFP? That is where traders on COMEX go to the London market, either to play price arbitrage with the difference in the price of gold or silver between the two markets, or they go for physical delivery. So since only 70 deliveries to end the month, the rest went over to London. It indicates that there was not enough liquidity presented on the COMEX for gold for the month. So some traders had to go over to London. That is quite a regular occurrence as of late, although EFPs have really spiked up in the last year to 2 years. And I believe that has coincided with silver squeeze and the movement into SLV and the amount of silver bought that happened to sit in the London vaults, which is why every single week we track inventories on both the COMEX and London to let you know what's going on. We're going to look at Wednesday's data again, just about the same. 21 deliveries, a ton of EFP. On Wednesday's day, you can see 5,312 contracts on the COMEX of 100-ounce gold flipped over to London. Again, that could be an issue with COMEX liquidity, or it could just be that they wanted to settle the contract in London for whatever reason, and they just wanted access to this London market. Could be price arbitrage, or perhaps there was a trader there that had the gold that they wanted. We don't know, but it's indicative of the fact that there probably was not enough liquid gold available in December to settle all the required or requested deliveries. Looking at the settlement data is where we get the price, and you get it right here. Here's the change for the day, and here's the settlement price. This is an average of all contracts for the day. And this data is put out by CME Group. Looking at the chart in gold, the February contract, we had settled down at $1,826 on estimated volume of 107,057 cents. Sorry, I had to clear my throat. That's Thursday's data. And then on Wednesday's data, we closed down about $7 to close at about $1,815 on the dominant contract month. You can see that on this line here. That tells you what the prices are going to be. And as we look at the silver futures ending the year, again, really light volume. Most of the trade for the year has been done. They closed out the month. The last 50 contracts were delivered. You can see here, and now we're at 0 for the December contract. The trade has now rolled forward to March. Again, this is a futures market, but one at which the spot or the current price is determined. In other words, all the market traders get here, all the people that produce and use silver, plus a bunch of more people that don't ever touch the physical to decide the price. It's a future. It's a betting market. The spot price is a bettor's price. It is not a physically traded price. This is something very important to know when you're buying physical silver. These paper trades are what determines what the price is that you pay for physical, and they're two separate and distinct markets. For Thursday's data on silver, the March is a dominant contract. We had 115,000 contracts at close, open interest. There were 2,258 added from prior periods and from new additional demand. We had 50 deliveries and 424 of the silver trades had to go to London on Thursday the 29th. On Wednesday, 422 contracts had to go to London. We had 189 deliveries. And if we go up here and just look at one more day this week, EFP 540 contracts, silver 131 deliveries. So this is the liquidation out of December positions, either in terms of delivery on COMEX or in terms of delivery, either paper or physical here on London. That's how you read those numbers. Of course, now we're going to go over to gold charts, and we're going to look at the ETF data and the COMEX data to get an idea of flow. We present this chart to get an idea of flow. This is primarily the American market, and you can see that there has been a net decrease in gold off of the American market. This is primarily the London market, though some of these ounces are stored elsewhere. For example, in the SPDR, some of this gold is stored in New York, I believe, and some of the silver as well. But most of this out of London, so this gives a pretty good idea of what's going on in London. And we've had a decrement as well. You can see, for example, as a proxy, if you want to know the largest fund that stores gold in London, you go down here to the GLD and you look at their chart, you can see there's been a runoff. That has not changed. A little bit's come back in, but not much, modestly. Overall, a net runoff in 2022, specifically the last 4 weeks, and specifically actually dating back to January of 2021 of gold off the exchanges. A more precipitous decline in silver inventories. We're now here on silver. Same chart, different metal. On COMEX, we've seen a net decrease of about, it looks like about 500,000 ounces of silver off the COMEX the last 4 weeks, and overall about 10 million ounces off of the combined US and London markets. And of course, if we want to look specifically at the biggest of the London ETFs, the iShares SLV, we can see the runoff has continued. There's been a little bit of silver come back in to the SLV, and there's been a tad amount of silver over the last week come back into the COMEX, although the last 4 weeks is net negative. So again, silver and gold running off of the Western markets. Well, now something very interesting has been occurring, and I've been watching this for a while, but took a minute to report it to you. I really wanted to get a good idea of what's happening and let that trend develop. But you can see here, the platinum inventories are coming way down. This is largely due to Russia, Ukraine, and the supplies from Russia, where the platinum group metals, PGMs, the platinum and palladium primarily, but could also include things like rhodium for using catalytic converters, have been coming down due to lack of available PGMs, sanctions, and the wartime economy. And you can see here, platinum ounces are falling precipitously across the complex, and the biggest ETF is seeing a precipitous decline in platinum. And then if we go down to palladium, a similar story here. You can see a decline off of palladium. The decline over time has been extremely precipitous. Back in 2015, we had over 3 million ounces of palladium in storage, and now we have only about 500,000 ounces in storage. Palladium is in a supply shortage from the major exchanges in as much as silver, and maybe even more than silver. So if you're looking for a short-term trade or a trade idea, this is not financial advice, but for research, check out palladium and see if that trade makes sense to you. It definitely looks like it, at least for now, given the situation with Russia and given the situation of exchange metal, what's sitting on there that we could go get industrially, there's not a lot. So a little bit of run on platinum and palladium as well. And to that extent, I wanted to take a moment and share with you some charts on what's going on with platinum and palladium as well. I'm here at JM Bullion's website, and you can see sort of the price history here at the top. This is for platinum, and you can see in 1990s up until 2002, we had relatively modest prices. When I started covering platinum was right about here. I think we had gotten to about $600 to $700, and I started writing a little bit about it here and here. And then we had a nice little rise above 2000 and then a precipitous decline. And you're going to see this precipitous decline had to do with the fact that there was less platinum demand, and this had to do with the fact of the Great Recession. So as we reduced automotive demand, catalytic converter demand for platinum or just overall, the use of platinum palladium fell, and it didn't recover until the economy started to recover. So platinum and palladium, unlike gold and silver, are highly dependent upon the economy in recessions and booms because they're primarily industrial metals. There's not as much demand in terms of monetary value. So they're highly dependent upon recessions. And given that we're going into another recession, there could be weakness coming up in the platinum price. And you can see this weakness basically this year as we've experienced that recession. If we go over to palladium, a similar chart, I wrote right about here, I thought palladium could hit 3,000. It bumped up against 2,800. I think 2,877 is highest. And then it came back down. It got a little frothy. And again, I think the events since the pandemic have caused a reduction in overall auto demand. And we're having some buildup in auto inventories right now as the auto market starts to wind down as we head into this recession. So I think the demand for platinum and palladium and the prices could come down a little bit, but at the same time, we're having some short-term shortages. So that's something that we also want to pay attention to see if this issue is going to persist. Now, I want to let you guys know we do partner with JM Bullion. We do offer free shipping on orders of over $199. If you're interested, there's a link down there that you can click on that'll allow you to take advantage of that, and it'll take you to JM Bullion's website where you can look at all of the metal store there. They're a full service metal brokerage. And I wanted to bring you one of my favorite bars that I like to use, and that is the British Silver Britannia bar. I happen to have one with me. It's a beautiful bar. You can see it's just a gorgeous design. It really stands out, and I really love the British coins. They're gorgeous. And then on the back, of course, you get the mint mark, the Royal Mint, and then, of course, the fineness. And it's just such a gorgeous bar. Just look how beautiful that is, and look at how it shines. Such a gorgeous bar. They have those here at JM Bullion. Right now, at the time of this recording, they're running $348, but you can come back to check prices if you wish. And I think that could be a good option for you if you are looking to purchase some precious metals. We fully recommend JM Bullion, and it does support the channel. All right, this has been the weekly market wrap up, the last one for 2022, guys. We talked about platinum and palladium shortage, and we also talked about the oncoming recession and what factors could then affect the platinum and palladium prices. They've got competing pressures, so we have to look at that. We talked about the economy and what was going on there. We talked about some weakness in the bond market and the stock market to end the year. Gold and silver have done very well in comparison. We've talked about big economic data reports coming out next year with employment, but this year we can see some continued weakness in real estate, some continued weakness in home sales, continued weakness in the job market, but a surprising nice little boost in purchasing manager index due to the fourth quarter and the holiday season. That's going to wrap it up for this year, guys. We'll come back next week and have another weekly market wrap up. Stay tuned to both the JM Bullion and Gold Silver Pros channel. We do this every week. We give you the biggest economic events. We give you a market readout. We go in detail on the precious metals. We bring you the important stories for the week. And more than anything, we prepare you for the week ahead in the financial markets. Thank you so much for tuning in. Have a very happy new year, and we will see you again same time next week.